Hey there. Welcome to the If Money Were Easy podcast, the show where we teach you how to expand what's possible with your money. We're your hosts, Neela Hummel
and Mary Beth Storjohn,
certified financial planners and co-CEOs of Abacus Wealth Partners. Today on the show, we're going to talk about considerations for disability and life insurance.
Very proper. We are very excited to have Mark Maurer joining us on the show today. Mark is the president and CEO of Low Load Insurance Services. Mark grew up in the insurance industry, learning from his parents' experience. He joined LLIS in 2003, earned his CFP designation in 2006, and became a leader in 2012. Under his guidance, LLIS has expanded into services for fee-only financial advisors and their clients. Mark's industry experience has helped uphold Low Load's commitment to quality information and customer service, a tradition since 1992. He also introduced ALLIS, I think that's advisors, right, Mark? Well, he's going to tell me, a client management system, that enhances the firm's approach to meeting client needs. His team of over 20 members adapts effectively to continue seamlessly supporting advisors and clients, demonstrating resilience and dedication to service. Mark, welcome to the show.
Thank you, everyone. It's always so weird to hear somebody describe you in 3 or 4 sentences in the bio. It's just,
and you have to sit and listen.
You do. You have to.
It sounds like somebody kind of old and respectable and.
I've just seeing you just now. I have known you. I have known you for years, or maybe a decade at this point in time.
Yes.
So I'm like, well, we are all. If you are old, I'm also old, and so that is
maybe not
okay.
old, just kind of stuffy.
It sounds like there's a lot of.
I need to work on that.
You have a lot of wisdom in your bio. I think there's just a lot of wisdom there. A lot of wisdom.
I think if you start calling the client management system Alice and
is it Alice?
Alice, it's Alice.
I think it's Alice. I haven't used it in so long since I haven't used it. I was like, I know I've used it. I've seen it because I've used it. But I'm like, I don't remember what it's called.
She's a whole person. She's a vibe. I like it.
She's very helpful. She is very helpful from what I remember. I haven't used her in a while, but it is great.
Give it a couple of years and she'll take over. The world.
Ariel uses Alice. I think Ariel uses Alice.
Nice.
Yeah. So okay, into our episode here today. I think, Mark, I want to kick off with the obvious question, which is, why are people so apprehensive about insurance?
Why? So there's a couple things. One, I think, is it forces us to think about things we don't like to think about. And me, I grew up, as my very proper bio says, grew up with my mom and dad who were in the insurance business. And so when you think about life insurance, we think about, you want to say life, but really it's something that happens when you die. And people don't want to necessarily think about death. But you have to have it so that if something did happen to you, your family isn't decimated. It's just, so it's important to have. Same thing with disability. We don't want to think about not being able to work, being hurt, being all these things. So there's part of that that I think is just hard for people to think about. Same thing with, I'm sure, almost all aspects of financial planning, getting wills, I think even some people think like, well, if I make a will, I'm going to jinx myself.
Yeah.
Well, that's not really true. It just means you've done good planning in case something happens to you. And the other thing is, insurance is, you pay for it and you hope you never use it.
Right.
Right. Yeah.
Amazon Prime, I can get a garden hose, a T-shirt, and probably a book by tomorrow if I wanted it, and I get to use it right away.
Right.
I pay hundreds of dollars a month in my own personal insurance, term insurance, disability insurance, and I really never want to use it. So if life works out well for me, I will get zero benefit from it. And I think that's we can put money in our 401k. I see it grow. We pay down our mortgage. I see my mortgage balance grow smaller. Life insurance, I'm paying for this term every year. Yeah. But at the same time, I pay for auto insurance and hope I don't get in a car wreck.
Right.
I pay my homeowner's insurance and I don't go, ooh, it's been a couple of years, kind of hope I have a fire.
Right. Like the goal is to waste money on insurance.
Yes. Yeah, so certain things are exactly what we want to waste this money. We want to basically throw it away because if we use it, things went wrong.
God, there's like so many threads that I want to pull on based on what you just said. But growing up with parents who are in the industry, can you think back of a moment where you really felt the value, maybe as a kid, or some story that your parents shared with you that you were like, oh my gosh, this is so important?
Mhm. I can't think of one in particular because it was all sort of high level. I don't think we talked about it that much. It really was when I got my first job, which wasn't working with them. I think it was working here was my fourth or fifth job before coming in the insurance world. And just sort of that first job and realizing, oh, I have all of these things to take care of, and seeing people who were having things in life. The older you get, the more you might meet somebody who does die young. And seeing all of those things and realizing, okay, that's those people who did have insurance are better off than the people without. And that's, I wouldn't say 100%, but I'll go 99.9%. Somebody might be okay without insurance, but you're better off with it than without it. And so realizing, I think at that point, just moving to just sort of a more adult idea of what can happen in life. When Mary and Beth and I, first met each other, probably neither of us were thinking about long-term care because that was something that happens 20, 30 years ago.
To much wiser people.
20 or 30 years out.
Much wiser people than us.
More seasoned people. And, my wife and I bought ours last year. So things just happen. So.
Yeah. So with that, this idea, you're talking about, this as you get older, I'm like, oh, when we all lost our innocence, we realized we needed insurance. That's what happened. Okay. So realize how dark and scary the world is. We got to arm up to protect ourselves. With that said, there's two things, and I love talking about the psychological element of it. I mean, 20 years in the industry, I'm always fascinated when people, I have definitely encountered people who are like, I don't need life insurance. I'm like, what makes you so special? And so that element of it is interesting to me. But with once that one decides they want life insurance or disability, any type of insurance, that's, you could decide, like, identify the problem. Yes, I want this. And then you're encountered with an alphabet soup and a variety of options. And we have things like disability insurance or life insurance. If you have an employer that offers benefits, I might have a group benefits, right? Group policy that I can enroll in. And how do I know? Let's tackle like disability insurance first. Like, how do I know my group disability policy? Does that suffice? Do I have to get an individual one? What makes it that I need a different outside policy and that I'm not just covered by my employer? What are the considerations I should be making for myself?
That's a great question. So group coverage usually has two different caps to it. So it will have a cap of a percentage of your usually salary up to a monthly cap. Most common is $6,000 a month up to $10,000, or 60% of income up to $10,000 a month. So when are considerations? Well, first thing is, if your employer pays for it, that's fantastic. I'm not paying for it, my employer's paying, that's great. But any benefits you get would be taxable, like your normal salary. So when we hear 60% of income, we might have numbers, but not realizing, okay, that's 60% of, again, it's 40% less, assuming the same amount of taxes, which still pays for groceries, still pays for a lot of things. Not going to be a lot of wiggle room for extras, but it still should cover groceries, mortgage, things like that. I think what a lot of, especially people who are working with financial planners, may or may not realize is that most group plans cover base salary. So people who make $100,000, $150,000 in bonus, variable compensation, commissions, K1 distributions, all of those things may not be covered in that base salary part. So automatically, if you're making $100,000 extra a year in commissions, that's $100,000 that isn't being covered. So your 60% for a lot of high earners is not 60% of what you're taking home. It's 40, 30, 20%. So I'd say that's for most people. So when you have a one income household, I think it's very important. The group is either paid for by the employer or you sign up for it and it's very cheap. I tell people do that 100% of the time. And then if we want to supplement because that 60% doesn't quite meet the numbers, you've got a lot of variable income that's not covered, then a supplemental policy that lays on top of it is a great plan.
Yep.
If you had a couple both making $100,000, 80, 90,000, 100,000, and they both have a group plan of 60% to 10,000, they're not hitting the cap. The 60% each is probably okay because we're assuming the other one could still work. Again, being risk averse, being raised by insurance people, I would say everybody should look at that supplemental just to see what it is.
Yeah.
But I would say for them, it's not as important as a one earner household.
So if you're making six figures or if you receive a bunch of compensation in any form that is not base salary, you should absolutely look at what kind of coverage that you might need on top of an employer plan.
Right, because your gap, if you're making $60,000 a year, that base coverage, is either low cost or paid for by the employer. Your percentage is going to be spendable. Is still, you're not hitting that $10,000 a month cap, and disability coverage because you're more likely to become disabled than die by age 65. DI is on sort of benefits a little, it'll cost more per year than a term policy. So if that's okay coverage, I'll segue into group term. Most group term may only cover $50,000, $100,000, 1 to 2 times salary. And if you have kids, I like everybody to have 10 times earnings. Even then, if you're 35, you may have 20, 30 years of income ahead of you, and that's a better number. But 10 times earnings would probably mean you don't lose the house. A surviving spouse is going to probably have to go back to work or keep working. It's lots of things, but 1 to 2 times income for a 35-year-old, that doesn't get you very far.
Yeah. So I'm going to close up on disability insurance quickly. So we talked about group policies, supplementing with private individual policies. And let's just talk for a minute about self-employed entrepreneurs, those that are, there is no group policy unless you're part of some association and you're lucky. But what happens when there aren't those options?
Then instead of having this group base, like I always love on a Zoom call because if people can see my hands, can't do that in a phone call. So instead of this, you have this group base, and now we're going to supplement on top. You basically need to have that business owner buy their own.
Yep.
Start from there. And with disability policies, there's a lot of neat riders or extras you can add on to them. The ones that we recommend are ones that I have on my own policies, but a group plan isn't going to have things like an inflation rider that once you go on claim, it keeps paying, it increases your benefits every month as long as you're on claim. That's a neat rider. It's great to have. I have it on my own policy, but a group plan doesn't have that. So a lot of times if we're starting with a self-employed, a business owner who has nothing, I might show 2 options. One is the way I have it for myself. And then a second one to say, but if we wanted to make yours look more like a group plan, here are some additional things that I like, but to keep the cost down, let's sort of simulate your own group plan as close as possible to maybe bring the cost down a little bit.
Do you have go ahead.
I was just saying, I think that's one of the things you mentioned, the costs that I've seen over the years. Group versus individual policies. There's a significant price differential there. So what have you found? And I think life insurance makes a lot of sense to people. And it's funny that you say you're more likely to end up disabled, right, than you are to die. But disability seems to be one that folks are more resistant to in terms of the cost associated with it. And so when you kind of throw everything in it, right, everything in the kitchen sink at the policy, and it kind of comes at this astronomical number, talk a little bit just briefly about what are the levers that people can adjust or pull to kind of adjust pricing or things they want to consider?
Sure. So there are a number of different riders and there's things we can drop off. Probably a base policy, if I cut out, like I said, I like them, we'll call them extras for this, but a disability policy is going to say, after you have been unable to work due to injury or illness for X number of days, we will pay Y per month for Z period of time.
Mm-hmm.
And those are our basic levers. So normally we look at a 90-day elimination period. So with the idea that most advisors want clients to have 3 months of emergency cash. So there's nothing probably more of emergency than not being able to work for 3 months due to injury or illness. So I use up my emergency fund, and then my disability benefits kick in after 90 days. And it's going to pay me $7,000 a month based on my income to my age 65. So what levers can we pull? We can pull, well, Mary Beth and Neela really want everybody to have 6 months of emergency fund. Well, I can have a 180-day elimination period. And that's going to lower the cost. I'm self-funding more of that upfront needing the benefits, and it reduces my costs. Maybe I qualify for $7,000 a month, but really I could get by with $6,000 a month or $5,000 a month. Because if I own the policy myself, now these benefits are tax-free.
Right.
Right.
So if I lower the benefits by 10%, I lower the premium by 10%.
Right.
I may
Elimination period is probably new for many listeners, but a lot of people are used to the concept of a deductible. And you kind of think about elimination period as like the deductible for disability insurance.
Exactly. And it's a deductible in time instead of dollars, the way it's phrased. But it could be the same as dollars. If it's $7,000 a month in benefits, I either have a $21,000 deductible, that's 3 months, or 42. My wife's the math teacher, so yeah, got it. Boom. 42,000.
She'd be proud.
Can you tell her that she should be proud?
I will. We'll actually send her this recording.
That would be good. Just that snippet. That's all.
Just a little bit, yeah. Watch the math. Watch the math mapping. Yes.
I think you also pointed out just one interesting point on taxes, right? If you're buying your own policy and you're paying the premiums, the benefits you get are tax-free. But if your employer is paying your premiums, then you get taxed on those benefits, right?
Right. Exactly. So a $6,000 a month group plan that my employer is paying for, I could say that's $5,000 a month if it's tax-free, or $4,500 or. And then the third lever would be that to age 65. A lot of companies have a 10-year benefit period. Most have a 5-year, a 2-year. All of mine are to age 65 because, again, my concern is not necessarily a short-term issue, or for the most part, I sit at my desk. My concern is something like a stroke that messes with my cognitive abilities. And at that point, then I'm probably not able to work in anything kind of ever again. So I like the age 65, but to bring it to a 10-year benefit period, if everybody's doing well and has a good amount of savings, they say, okay, we could maybe possibly retire in 10 years. And then that, I think that comes to the question is retirement. Does that mean when I want to stop working, or is that when I can stop working? And some people, I always get that sometimes. Well, to retirement age. Well, I might keep working. Well, okay. When do Mary Beth and Neela say you could stop? Oh, here. If you want to work after that, that's great. But how long do you have to work to make everything happen?
Right. That's helpful.
Oh, I love it. And if your head's swimming, just call Mark, y'all.
Okay. So that's disability insurance. I'm fascinated by all of this stuff. I mean, which says I'm a total nerd. I'm so sorry. I just realized that was, sorry.
All right. There's two of us.
Mark's also a nerd. Just
two of us in the whole country. Fantastic.
Just for working with clients. I mean, how many, I don't know how many disability insurance policies I've reviewed and pulled the levers on for the clients for the reasons, the different things. And you specialize in working with entrepreneurs. You're up, you're in those policies.
Yeah.
Okay, so let's pivot now to life insurance. And let's talk, I mean, we obviously are big fans of term insurance, right? But that's not the only piece to play in the insurance game. But talk for a minute just about, I know you spoke briefly about the group insurance, kind of the 1 to 2 times salary. That's cheap coverage. Take what you get, but that's a really base, thin level of foundation, and you need to build upon it. Tell us a little bit about what the options are in the market and what people should consider.
Okay. So for term, Term life insurance is, again, to use my example of our homeowners or auto insurance, term is what I call a pure insurance. You pay this premium every year. If you need it, then there's a death benefit paid to your beneficiaries. If you don't need it, you paid the $500 a year, $1,000 a year, and you get nothing back. So
Except the confidence of not having died.
Yeah, except that you're
Yes.
still here. You live another year.
again,
Here.
like I said,
One
all
more
of
trip
these
around the
things-
sun.
All of these things, if it pays out, you lost.
Right.
So that's why it's, again, not as much fun as getting stuff on Amazon.
Right.
So term life insurance is why it's called term, is that it has a period of time or a term where the premium is fixed. It's locked in, which again, unlike our homeowners and our auto and our health insurance and everything else, it seems to increase every year. And you go, what? I thought we just did that. Term insurance, it can lock in a premium 10, 15, 20, 25, 30. There are even some with 35 and 40-year level premiums. So you can lock in $1 million, $2 million, $3 million death benefit for a specified period of time. And what we try to do is line those periods of time up with certain life events. And I do that with, personally, when both of my kids are able to drive. So for everybody with kids, I think once kids are all able to drive, or at least one is able to drive, I have one who can. Life really changed. There was the ability for him to get himself places and even take his sister places if my wife and I were otherwise occupied. So, and if I'm not there in the world, that's a huge help. So kind of the need for care of children, I think, kind of it lowers at that point in time. Then there's college funding years. There's another period of time where I've looked at what college costs. I'm going to need to keep working as long as they're in college. If they want to go to college, I keep saying, hey, insurance, it's not a bad job, and I won't have to pay for college. And I know a guy who's could probably hire you. So far, nobody's bitten on that one yet.
It took you 5 jobs to get there, so maybe it'll take them 5 jobs to get there.
That's true. It might.
Right.
So, making sure my income's protected through college, end of college. And then the third one is retirement. And really within all of those things, we can look at how long somebody's mortgage is. Well, that's good to know, but all of it really is based off of my income and sort of that idea that everything I want to do is predicated on my income. So there's lots of different ways to value and calculate, and there's financial software does a great job of doing that. But also just sort of look, like I said, very round numbers, 10 times somebody's income is to me that minimum. Planning software is going to be much more accurate, much more detailed, because I don't know things like, they just won the lottery 4 years ago and, already have 5 million in the bank. I can't know that. But for your average person, 10 times income is going to get them, when they have kids, that protection of some kind of fairly good safety net that group coverage 1 to 2 times usually just doesn't get.
Talk for a minute. This idea of 10 times like straight through. Let's say 100,000. Let's say $1 million of coverage straight through to 65. Call it a day. Boom, you're done.
Yeah.
Versus the option of what you kind of just brought up, these different life events
Mhm.
and the idea of laddering policies.
Oh,
So
okay. Now I'm going to nerd out.
Okay.
So I
Okay.
love laddering. I love layering, because let's pretend I'm still 40 and I'm going to work, for round numbers, let's say 20 years. My kids are 10 and 12. No, they're a little bit younger than that. Anyway, let's say I'm making $100,000 a year. I'm 40. I might work another 20 years. So round numbers, $2 million. But in theory, I need a lot more today when I have 20 years of income ahead of me than I do at age 59 when I'm only going to work 1 more year. I'm pretty sure my last year of income is not worth $2 million. That would be great if it was. So the idea of laddering or layering policies, because the longer the term is, the more it costs. So in that scenario, if I could ladder some 10-year term, some 15-year term, some 20-year term, and have this, what starts off at $2 million, and then, okay, one of the kids can drive. Okay, that first policy, that 10-year term drops off. Well, I just save money. and now I have another that does, so it goes like that.
Yeah.
I wish I had a whiteboard.
Okay, so you do behind you, but it's too far away.
It's
But
too-
yeah, we need to. Yeah.
So that idea of laddering, and it costs less because I've said I need $2 million, but I don't need all 2 million all 20 years. So this idea of laddering, layering for different life events, I love, because it frees up. It costs less today. It costs less as these policies drop off, and then I'm not really overpaying potentially for coverage. Still having $2 million the year before I retire.
So
I
that you're
love-
saying is like spreading that 2 million across 3 different policies. So when you're going in, you know the amount of coverage you have, but you're going to have 3 different policies, and those policies will just expire over time.
Right. Yep. Then one's going to drop off in 10 years, and then another in 15, and then in 20 years. You all did your job. Client lived, client worked, saved, invested, and in 20 years, they're ready to retire. They don't need the term insurance anymore. And so that's in general why we look at term for almost everybody as compared to some of the other types of permanent or cash value life insurance policies that are out there.
It's so great. So it's like a good start is 10x earnings, call it a day, right? But if you want to kind of sharpen your pencil a little bit, you can think about what are the big events that you're really trying to cover for. And that's when the ladder approach comes in, right? And you talk about like minor dependents, college expense, maybe a mortgage, retirement, kind of you can start playing with some of those building blocks.
Right. Well, the first thing I would do is have them talk to you all.
Right.
To get a good financial plan together, because there's nothing more important than a good financial plan.
Right. Wait.
Love that.
Wink.
Love it.
But yes, I would agree. If somebody walked up and just said, I need some insurance, 10 times income to retirement age would be, it's like if I get one shot at this and we're worried about affordability or something like that, that would be my 10 times earnings. So using my 40-year-old, going to work 20 years, make it 100,000. $1 million, 20-year term is going to cover a lot of stuff. But like Mary Beth said, ideally, that first year, initially, it would be a lot higher.
Right.
But I might decrease it to where it's not even $500,000 those last 5 years, maybe.
Right.
I just realized our math got off. So yes, it's 10 times earnings. If you made $100,000, it's still $1 million. I think we did the 20-year and made it 2 million. So it's still $1 million policy for 20 years, as Mark just said. We just, if the math isn't mathing for everybody, it's $1 million, 100,000 times 10 is 1 million.
Don't show my wife this.
But
section.
over 20 years.
If I messed up the math, I don't want to know.
We both picked it up. It's great. Just continuing the story and the thread. Okay, let's talk for just briefly though about the term versus permanent insurance. Where does that come into play? My and Neela's favorite thing is when clients come in with the whole life insurance policies. We get really excited about that, don't we? So talk to us a little bit about that and when they're necessary, if they're necessary.
So with term, the whole idea is that it ends. And if we go back a whole number of years, probably not that too far, there weren't financial planners, there weren't CFPs. Most people didn't have Robinhood to E-Trade to any of these things. If you wanted to put some money somewhere, you either put it in the bank or possibly in a life insurance policy. So whole life policies were this, it slices, it dices, it Julienne's kind of thing. It's a retirement account, it's death benefit, it's going to be your college funding. And it's like there's not a fuel efficient Humvee or a Prius you want to tow a boat with. Nothing can be good at everything.
I'm like viewing the infomercial in my head though, and I think it's like
So
just like very it. That was a great example. Okay,
Great
continue.
visual.
Sorry,
I'm with it.
And I was able to find a Prius towing a boat one time on it. That was a pretty funny image too. So whole life is designed to be permanent life insurance. So it's not covering a period of time income replacement. It says, I want to leave money to someone when I die, no matter when that is. But as far as life insurance goes, it's definitely going to be more expensive than term because we hope we outlive the term. If it's priced correctly, it will pay out. You're putting it there, and instead of investments, instead of other things, paying down debt, it's going there, and the costs are higher again. So who is it good for? I think a lot of people have it. A lot of people possibly were sold it. a lot of people might want to leave their kids $100,000, and they can leave them what's left in their IRA, their 401k, their Roth, the house. They might want to leave them permanent life insurance because there are some neat parts about it. It's tax-free. It passes to a beneficiary, so it doesn't go through probate. You can name beneficiaries. As you pay money in, it grows on a tax-deferred basis. You can take withdrawals up to your cost basis. You can take tax-free loans. So there's a lot of neat parts about it. What I think many times isn't explained is that there are still insurance charges. So here's all the neat benefits of it, but you're paying these expenses and you're paying them for your entire life. And so I'd say there are times when it makes sense if people have an estate tax issue, which under today's numbers, that's not very much of us, but you might. Sometimes estate planning, not necessarily estate tax planning, but estate planning. Somebody's net worth may be very heavy in a family-owned business or a farm. How do you give one kid the farm when that's 80% of your net worth? And do you cut out the other kid, or do you give them half ownership of the farm? Well, maybe they don't want to do that. So life insurance can be used to equalize an estate. We use it sometimes for special needs planning. You have two parents with a special needs child. Many times that special needs child might have a life expectancy of longer than the parents. And so we have our term and our disability when we're younger to make sure that we can replace income. But as long as one parent is alive, we're going to provide that care for free as long as we can. But what happens when both parents aren't there? And maybe now there's an adult special needs child. He is a child now, but he's adult. Now there's a survivorship or second to die permanent life insurance policy that comes into play to help a sibling provide care, or maybe a facility where all of a sudden there's this thing we needed a big bunch of money when both parents are gone. And sometimes people just want it. I'd like to leave my kids $100,000. Okay, you can do that with a life insurance policy. You might be able to do it with lots of other things, other assets, but I find a lot of people who were the beneficiaries of a life insurance policy at one point from their parents liked it. And again, I have yet to have anybody try to send money back. Didn't need that. No thanks. Y'all can keep that.
Do you ever see it also? I've seen it a few times. If people have a term policy, but might have a hard time getting underwritten for a new policy, and that they can basically, their term policy can kind of turn into a permanent policy? That's
good question. So we call that conversion. And do you see what I did with my hands? I just realized I did
converted it. You've done it.
Now I'm regretting that you all can see me. That was weird.
It's okay. So, it's part audio. There's a YouTube, but there's audio too, so some people might not see it.
It was very kind of Dr. Strange or something. I don't know what I did there. So within term policies, you have this provision that allows you to exchange the term coverage for permanent coverage. So that would be the whole life, universal life, something with cash value, without any medical questions. So I got that term policy when I was 40, 8 years later, have cancer, want to make sure my coverage doesn't lapse. I can convert it. Now I convert it as a male age 48, kind of you convert at the age at which you are when you do the conversion. But if I was issued preferred back at age 40, my new policy is preferred. Mm-hmm. So no health questions, no underwriting. So that's the real value to that conversion. The flip side is, instead of my short, low-cost term, I'm trading it for permanent coverage. But maybe if I'm uninsurable or new coverage would be very expensive, it might still be a good idea. But for the most part, if I can get new term coverage, it's probably going to be a better deal.
I feel like we could nerd out on this for literally hours.
Well, this is going to be a long episode, which probably
probably
transition to our wrap-up questions, even though I have 5 more things to talk about. That do a part 2.
Fine with me. I can, again, I can talk insurance all day. Which,
I know it's batching it for our listeners. They might not want to hear all of it.
They're like, you all are monsters.
Yeah.
But go ahead.
So like
So mean.
microdose it for them, just like subsets down the journey. I was like, so much to talk about from like underwriting too. Didn't even go there.
Right.
Okay. Okay. So let's transition to the wrap up questions. Mark, what would you say is the best financial advice you have ever received?
I'm still good. I like this one. When I got my first job, it was to open up a Roth and contribute to that. And that was great.
A good one. Our good old friend, Roth, every
Solid.
financial planner's best friend. What is your favorite money mistake you've made and why?
I thought about this one and I don't know if it's favorite, but it might be more most recent. And I think it's a good story. So we had a 20-year-old dryer, just clothes dryer, and it stopped working and realized the part was going to cost more than buying a whole new dryer. We bought a new dryer. It worked for about 2 weeks. Needed about 6 new parts because the motherboard and all the electronics. This is a 20-year-old dryer. It had 2 knobs, on, dry, hot. I really wish I would have spent more money and fixed my old dryer because it had gone 20 years. There was no computer. There's no beeping. There's no computer motherboard. No, I think it was whatever that is, the drum and something that made it hot. That was
right.
it. So 2 months later and trying to get things repaired and we ended up actually having to buy a second new dryer because the other one, they would send parts in piecemeal. And after like 3 or 4 months, we still didn't have all the pieces to fix it. So yeah.
Air drying the clothes. That's
They've gotten so fancy. They're like, you can now control the washer with your app. I was like, but why?
But why?
You
can't put the clothes in there with the app.
Yeah.
You still have to. Why can't
No.
they?
Does it magically move from the washer to the dryer?
Right.
If not, I don't care.
Right. I'm out enjoying dinner. Ooh,
Yeah.
You know what? I'm really thinking about laundry.
One more spin cycle just because I'm feeling
Just in
frisky.
case.
So that was the one that most recent. I wish I would have spent the extra money and just fixed it. It could have lasted 6 months, but at least I wouldn't have.
You wouldn't have had like this. You would be wondering about it now. You wouldn't be. You wouldn't be wondering.
I would have said I knew it was a gamble on a very old machine, but okay.
That's a good story. Okay, fill in the blank. If money were easy,
I'd be walking in the woods.
Ooh.
That's we're in Tampa, Florida. We have heat, we have sun, we have beach. So mine would be just out walking in the woods, someplace quiet.
Like that.
Very Robert Frost of you. I like it.
All right,
I'll take
Mark.
it.
Tell our listeners how they can contact you, where you're at on the internet.
LLIS.com. You can find us there on our website. And again, Mark Maurer or Mark, Maurer at LLIS.com if you're using the email.
There you go. Mark has a great website, lots of client resources, advisor resources.
The ability to get quotes and things like that.
Yeah.
So you can just like test drive things with our good friend Alice.
Alice.
It's Alice, yes.
Not ALLIS. That was very long.
Is it-
So
yes, it's called
wordy.
Alice?
Alice. I didn't want to assume.
Thinking Mark needs to work on this.
I didn't want to assume, I didn't want to be.
Mark, thank you so much for joining us.
Yeah, thanks for being here.
Thank you, ladies. It was fun.
Thank you for joining us for another episode of If Money Were Easy. We hope you're walking away with some fresh insights, maybe some inspiration, and some ideas to apply to your finances, life, etc.
If you're excited about these conversations, we would love for you to follow or subscribe on your favorite podcast platform and YouTube. It's one of the best ways for you to support the show, and that way you will never miss the latest from us.
We're also turning If Money Were Easy into a community, and we'd love your help building support. So leave us a review, share your favorite episode with a friend, and we'd be super grateful.
We are also launching a newsletter. There you will get the episode updates, behind the scenes content, all of the bloopers from Neela and I, and what we are reading, watching, and listening. You will find the sign up link in our profiles.
The bloopers are choice, just going to say. They're really,
great.
really great. Please connect with us on Instagram. We're at Mary B. Storage and Neela Hummel CFP.
Thanks so much.
Thank you.